Now, when we turn to the U.S., we want to look at what is the Fed going to do, because one of the things that we've been saying is that the Fed was going to raise rates again. We still believe that June we're going to get another increase in rates of about 25 basis points. We do think right now, based on the data, that will be the last raise. So we don't see or are predicting anything more. Initially we thought we could get closer to 5.5 to 5.75. We initially were at between 5.25 to 5.5. We raised that as things started to accelerate. Things are starting to cool off a bit. Again, the consumer has been more resilient than we expected in Q1, but they've started to break down in Q2, which is why I think there is likely going to be a pause at that 5.25%. But we do hold to the fact that where they stop, we will be at that rate for 12 months. We don't see a cut. We don't see anything at this point in time that is going to drive that down, because they need to let this work its way through the system. Now, one of the things that is going to be a problem is U.S. Treasury cash balances and extraordinary measures are continuing to be a problem. This is so essentially June is when they have to raise the debt ceiling in order to adjust some of the things that are happening. And that's going to become a bigger problem in general, because it's political grandstanding. At what point do we get this pivot? At what point do we it's just nonsense. But when you look at the spike yesterday in the 1 month, when you look at the US Treasury yields, it's now above where it was during the great financial crisis and what happened there. So again, you're seeing the pressure. There is the warning signs are everywhere, and the fixed income market is the only one yelling them, because now don't get me wrong, the equity market has softened a touch, but the differentiating factors between the fixed income market and the equity market is fascinating. And the fact that you still have this disconnect, it's not, we don't think the fixed income market is wrong. Like, what we're looking at is actually what we think is the likely piece versus the equity side. Now, an interesting point, and I think both these charts are important because it shows just the magnitude. So interest expense is rising, and it's going to continue to rise based on inflation, higher interest rates. So when you look at the low of April 21 at about $350 billion in interest payments, now we're paying about $617 billion. I mean, you're looking at over $250 billion additional money going purely towards interest. And remember, we're still running a deficit. So you're still seeing a deficit when you look at what is currently being put into the market, and because we have to roll that debt, and then we're layering on top of it. That is a huge problem when you look at just amassing more interest. Now, when you look at the federal government current expenditures interest payments, you get an idea of just how high that's gone. And we are approaching $1 trillion in interest payments. 1 trillion. That is a massive number when you look at where things are going. And because of this liquidity sloshing around, we have to keep, I believe the Fed is going to keep rates higher. But this is a big problem when you look at what are things going to happen, how are things going to be done. And we're going to have to cut back spending at some point in time to address the fact that we're running a deficit that is unstable, and the cost of doing so is going to be a growing overhang, because it's growing exponentially because of not only the roll, but also the additional new debt. Now, one of the things that is funny before we go into the next segment, the next piece of this conversation, Powell. So Powell has come out and has essentially signaled out core services ex rent as the only inflation print that matters, which is 24% of the CPI basket. So Powell's essentially saying that less than 25% of what the consumer actually spends money on matters for inflation. Myself as a consumer, I can wholeheartedly push back on the absurdity of that, because everybody has seen the same pain points. 3-month annualized change in core CPI inflation barely budged in April, ticking down slightly to 5.1%. But again, that's still massively high in relation to history, and is like stuff that we had in the early 90s. Again, this is not going anywhere. And as you can see, it actually pivoted back up. Now on a month-over-month basis, again, inflation staying elevated, 0.4 versus the estimate of 0.4. And then when you look at the core CPI, the estimate was 0.4, came in at 0.4. But look at the numbers, and this is what I like to point out, and this is why I'll push back on anybody that talks about year over year. Year over year is showing you the rate of change. Anybody who's been watching this show knows I've been saying the rate of change is going too slow. But the month over month number is a compounding number. Every month, this is saying that every month has been above the previous month. So again, for 3 years, the consumer month in, month out has seen their prices go up. Have they been driven by different things? Yes. Was this most recent one driven by used cars, cars in general? Yes. And everyone's saying, whoa, we shouldn't count that. It's like, well, you could have said several other times throughout this cycle that car prices collapsed. Therefore, we're holding things constant. Are things overweighted to the car side? Yes. But anybody who has had to buy a car over the last year and a half has experienced a massive increase. I mean, we're at a record low ever of cars sold below $25,000. There is no starting line now below that 25 unless you go into the used market, which is why people are like, I can't afford a $35,000, $45,000 new car, so I'm going to go to the used car market, which is then driving up those prices. So again, these are impacts that are real and not going away anytime soon until we get a much bigger increase in inventories to drive some of these down. But yes, we are seeing this convergence. Some things are starting to converge, but we're actually getting commodities. And when you look at in terms of the commodity side, that blue side is starting to, inflation's peaking up again. Services starting to curl slightly, but again, as for anyone who's been following us, we think services will be sticky, but it's going to come down. This is a year over year number. Of course it's going to come down. The pace of inflation is slowing, but inflation is not going away. That is why we continue to say that the Fed is looking at this and knows that they have to do something to continue to show tightness, to continue to show this fortitude that they're going to get in front of this. And the jobs market confirmed that. There's nothing in the jobs market that says they need to cut. There's only signals in the jobs market they have to keep raising. So then when you look at PPI inflation accelerated after the last month's drop. PPI came in at 0.2 versus the estimate of 0.3. Core PPI came in at 0.2 versus the estimate of 0.2. So this is where you start to kind of get this back and forth, where you had a little bit of deflation, but then instantly you had a pretty quick reversal. Now, it's not a reversal that is reaccelerating it. You're now finding, and again, this is what we've been talking about, the stickiness, where we're not getting this big drop down. We're on a month over month level. You had some better months, then things started to get worse again. And this reflects what we talked about with the regional Fed data. The regional Fed data was saying, look, prices are going back up again. We talked about it when you look at April. April was when you had the full impact from the OPEC cuts that sent crude back up. And again, this is a key piece that we continue to say play out. But on a year over year level, things are slowing. The rate of change is slowing, but it's not deflationary. And that is a big problem when you start looking at what is driving it. So looking at final demand, final core, you get to see kind of where those averages are. So goods was up 0.2, food was down 0.5. But remember, back in segment 1, food's actually accelerating again. So it's not going away. It's improving slightly in general. But again, that's something that we do think reverses. Services was up 0.3. Again, that is something that continues to be sticky. Transportation was down 1.7%. So you should see some of that transportation pass through to the CPI side, because realistically, the numbers were very egregious to the upside. They'll drop back down, but it's not going to be enough to see a lot of this inflation pare back. There's still that pressure point, but we're going to have to see more pain for the consumer. So again, April CPI inflation, 4.9% versus the estimate of 5.5%, but core CPI, 5.5 versus the estimate of 5.5. So inflation slowing, when you want to look at it, they can sit there and say, okay, well, inflation is slowing, therefore we're winning. But inflation's slowing, but wages are slowing more. Real earnings are down for a record 25th consecutive month. Real earnings have declined. So when you look at this in general, and this is the big piece, because everyone's saying, oh, well, look at the win because inflation is coming down. But if inflation's coming down, you want to hope at some point that you'll get a flip where wages go positive. And it means that people are now back in the money versus where they've been. But as we've been saying from the beginning, the real wages have been overstated for an extended period of time. They've been hiding this inflation in terms of underweighting things, overweighting others. And which is why for anybody that has sat back and said, I'm working so hard, I'm making more money now, but yet I feel poorer. I don't feel as wealthy as what my income is telling me. And this is now this catch up where real wages are showing you the true impact of where things are. And it's not getting much better. And that's why we continue to see real wages shrink. And that's, again, going to weigh on the consumer in general. So then when you look at Federal Reserve consumer credit outstanding, there was a huge jump in consumer borrowing in March, with total credit expanding by $26.5 billion versus $15.03 billion in the prior month. Revolving credit includes credit cards increased by $17.59 billion, which was the largest jump since March of 22. So that's when you start looking at the consumer. There was that last hurrah where they essentially layered in that additional credit, but it is weakened since that point, which is why when we talk in the next segment about Q2 has been weak, and we see it continuing to weaken into the summer months, which again is that core piece for buying for summer activity. And in the last months alone, office DQs have risen, or when you start looking at office defaults, again, you're seeing these pressure points. You're seeing it on the consumer side. You're starting to see it more and more on the office side. And real estate is a big piece of the economy. And that's where we continue to see some of these pressure points. Finally, starting to see some relief in trend for owner's equivalent portion of CPI. 6-month annualized change still in an uncomfortable territory. So it's when you look at the change, it slightly came down to 7.96. When you look at urban consumer owner equivalent, you're still at 8.1. When you go back to 1984, this is the highest it's ever been, and it's still going to go up. It will start, the trend of it is drastically going to change. Like the year over year is going to slow aggressively. It's going to flatline. It's going to start to not roll over, but just go up at a slower pace, but it's still going to go up. And yes, have things improved over the last 6 months? Yes, but they've actually started to get worse again on the rent side, which is going to keep this elevated for a lot longer than what the Fed wants, which is why we still believe they're going to have to keep those rates elevated. Aggregate savings following the onset of recessions, as you can see, is coming down, but there's still some out there. But as we've been saying, it's weighted towards the top. A lot of that, when you look at credit card spending, the top has slowed. So we do see more pressure in general there. Now, office obsolescence, when you look at the office bankruptcies, face challenges, 60% face challenges. The bottom 25% is now obsolete, and that's where you're gonna have this shift because, and just using New York City as an example, Midtown is prime. So typically, as Midtown prices come down, people from downtown and up and further uptown will converge onto Midtown. But then that means that the weaker in the downtown uptown side are obsolete, which then means that they're going to get purchased, they're going to get renovated. Those are those cycles that we continue to see. But the problem is some of these buildings were already renovated, were already struggling prior to the full-on effects of where things are. And I don't mean struggling in terms of occupancy, but in terms of rate of return, because the expectations really for some of these purchases were zero interest rate policies, which are gone forever, or at least hopefully as long as I'm doing this job. So when you look at that, it's going to be difficult. And that's why you're seeing repeat bankruptcy filings accrue at the fastest pace since 2009. We are not in a good position or a stable position, which we think is going to get worse on the real estate side, as well as just on the corporate level. So then the net percentage of domestic banks reporting increased willingness to make consumer installment loans is at the levels that we saw in COVID during the great financial crisis, and actually even worse than where it was in the early 90s. So again, you're seeing the pressure here. The Fed and while this is happening, the willingness is coming down because there's a huge panic as rates go up. And it still blows my mind. And I've ranted about this for people who have called me. I've gone about this in general. The Fed is never tested for higher interest rates. It just gives you the absurdity of, for some reason, nobody thought this was possible. Nobody thought interest rates were ever going to go up, and I don't know why. I shouldn't say that. I do know why. Everybody got lulled into the sense of, well, interest rates never go up. They've only come down since the 1970s. It's like, until they don't. And I came out and said in 2020 that this was the end of the bond bull market, and people thought I had lost my mind. And clearly, the Fed thought I lost my mind too, because why do we have to challenge? We don't have to worry about higher interest rates. They'll never happen. Well, my whole thing was the Fed has no choice in rates. Rates are going to go up. Whether the Fed moves its interest rates up, the Fed funds rate up or down, the market was going to make them act. The market was going to make the ECB act. And here we are. They're forced to act, and now the repercussions are real. And some of these companies, when you look at what banks are willing to do, they're panicking because they don't know if they have the ability to. Can they lend this money? What is the bad debt expense? And that's where we continue to see this pain. Home buyer affordability, fixed mortgage index hooked lower in March from 103.8 to 98.6, lowest reading in 4 months. And as you can see, lowest when you go back to 1990, still one of the lowest on record. Another record increase for homeowners. So homeowner inflation's going up, affordability is going down, and again, prices will react to that. It takes time. I have said repeatedly, it is not a one-to-one. The home seller will hold out as long as possible until they yield and they say, fine, we're lowering prices. The Fed funds target upper bounds, 5.25%. Recent U.S. hiking cycles is still an accelerated basis. But again, this chart is flawed because it does not show the 1970s. Powell is basing his decisions off of what happened from 1972 to 1978. This is why we're at the rate that we're at. If you were to look at this, it would look more normal versus things that were very much in line with, which is what happened in the 70s. Net domestic reported, willingness to make consumer installment loans. As you can see, latest quarterly update for Fed senior loan officer opinion shows that negative 22.8% of respondents reported willingness to make consumer loans. Today's update for Fed senior loan officer opinion shows net percent of respondents reporting stronger demand for commercial and industrial loans fell to negative 55.6% for large firms and negative 55.3% for small firms, which, as you can see, is the worst it's been since the tech bubble burst and the great financial crisis. It is below pre-COVID. It was below COVID. So again, we are not in good company when we look at what the banks are doing and why we think the pressure is real. Fed's near-term forward spread has plunged deeper into negative territory and now well below the trough seen in 2001. Again, all the more reason why we think that this is going to push much higher and why we think this is going to get worse. Real Fed funds rate turning positive for the first time since 2019. Again, just gives you an idea of how absurd the prices were. Corporate bond yields less than the Fed funds rate today. Such a depressed spread wasn't even the case during the peak of the tech or housing bubble, which begs the question, why would anyone take on significant extra risk to invest in these instruments? During the global financial crisis, credit spreads surged from almost 0% to 8.10% at the worst of times. Wait until these companies have to come back to market. And again, because you have to compete against that, which is why we see the cost of business going up, the cost of debt going up, which is where you're going to get a big stress. You're going to get a big stress to the underlying corporate balance sheet. U.S. banking system, the great consolidation. Every failed bank that falls into hands of industry giants contributes to decade-long consolidation. Nothing changing here. And then the reason behind the bank crisis in one chart, the Fed has never once tested banks for higher interest rates, which is why, again, that consolidation is still going to go and continue at a healthy clip. Regular monthly rent monthly inflation ticked higher after, as you can see, starting to flatline. Came down at the beginning of the year, but now has reaccelerated. Change in monthly visits to the mall. As you can see, indoor malls, open lifestyle, outlet malls are all moving negative on year-over-year comps. And this is coming again with April having, a little bit easier comps, still getting softer. So when we look at some of the different pieces as we continue to go through the different levels, we're going to look at, again, revolving consumer credit, where some of these things are going, how that is going to put more pressure on the consumer. As you can see, they continue to soften as we head into Q2, further and deeper into Q2, which is what we're going to talk about in the next segment.